evening, everybody. I hope I am audible and that everyone can hear me now that I've turned on my audio. If I am inaudible, please do indicate so in the chat, just to let me know whether or not you can hear me and whether or not the video is playing okay. In the meantime, let me welcome you and thank you for all taking the time to join us on this webinar. That we've chosen to entitle Transformatics. And basically what we'd like to explore here this evening are some of the policy choices that we can make in order to create or discover a transformed post-pandemic economy. And to help us to do that, we have enlisted the expertise and the wisdom of Mr. Rejingosi to come and speak to us about that. You would remember that Mr. Rejingosi released a paper in about September of 2019 looking at some of these issues and a critique of South Africa's macroeconomic understanding, so to speak, and providing some insights as to what those policy choices could be. And so what we're trying to get to ultimately is policy that supports structural reform that moves toward and not away from transformation. What we're trying to get to as well is to a deeper understanding as to exactly where we are economically and macroeconomically, and whether or not in this opportunity that we've been provided by this pandemic to redesign production and consumption, are we using that opportunity effectively? And if not, what can we change in order to do so? And so I'm happy that you're all here this evening. I look forward to the engagements, but most importantly, I look forward to the presentation that Mr. Rejingosi that will give us in a moment, as soon as that we are able to confirm that he is online and ready to go. I'm just getting some having a look here to see whether or not they're succeeding. But while we wait, perhaps let's just go through exactly how this will unfold. We will have the presentation by Mr. Nkosi. Once that presentation is done, we'll ask a couple of questions, as well as open up then to attendees to ask questions of Mr. Nkosi to respond to as well. Should you have questions as he is presenting, please do write your questions down in the chat of the webinar, and in that chat we will mark those cues for them to show up in the Q&A session, upon which time then I will then ask them of Mr. Nkosi. Should I not be able to, or should I think that perhaps I will need the poser of the question to provide a little bit more context around that which they would like to ask Mr. Nkosi, I will call upon you then to just click on the speak button. That speak button in the panel indicates that you would like to speak, or once I've called upon you, for you to be able to speak, and then you can ask your question verbally. If I believe that maybe I may not be able to do your question justice. If you feel strongly that you would like to ask the question yourself as well, please do use that speak option, just to indicate to me and to the administrator of the webinar that you would like to ask that question as well. And then we will have that quick Q&A session and engage some of the ideas that will be presented here. And hopefully at the end of it all, we can package some policy choices that we can take forward, both in our individual activism and as an organization. So I'm looking forward to your engagement. I'm looking forward to both thoughtful and useful inputs, both to what will be presented by Mr. Nkosi, as well as from the questions and the inputs from the attendees of the webinar. We also will be live tweeting as we go along in this webinar. So if you would also like to comment on social media as to what it is that we're talking about here, or if you would like just to draw attention to a few points that come out of this engagement, do use the hashtag Transformatics. We will put that up in the chat as well, for its spelling and the like, so that we are able to collate all of these ideas that will emanate from this conversation. We will also be using the hashtag BMF Eastern Cape, BMF EC, BMF webinars. The handles that if you'd like to tag the organization on any of your comments to bring them to our attention more starkly will be that at BMF Eastern Cape or at BMF National. We have been alerted that Mr. Nkosi is having a technical issue with connecting. We'll play one or two of our promotional videos while we just try to get a hold of him. And when we come back from that, we will go straight into the conversation. So please do bear with us for just one moment. We apologize for that inconvenience, but we should get started in the next 5 minutes or so with Mr. Nkosi beginning his presentation. We'll play a quick video. We'll try to get him online. I'll just reintroduce to the attendees who he is, the topic, and then we'll get right into it. So thank you.
Black Management Forum creates a platform for development of managerial leadership and also advocates for social economic transformation. My participation at the branch forum level as an executive member has provided me with an opportunity to understand other industries. I have learned so much and had the privilege of being part of a conference that was held recently. Well-researched presentations, great panel discussions, policies such as black economic empowerment, employment equity, expropriation of land without compensation were thoroughly covered. It was enlightening because private
Part of the vision of the Black Management Forum is to be the most influential youth organization for young, particularly Black entrepreneurs and professionals within South Africa. It is the duty of those in leadership at the moment to hand over the baton of success, but it's our responsibility to run the race and continue on. The BMF also addresses the missing woman phenomena that is currently occurring in South Africa's top brass. One of the ways in which we develop our members is through two management development programs, the Women in Power Program and the Young Professionals Development Program.
One of the ways in which we develop our
I'm a millennial, and you know, sometimes you struggle in the corporate world, whether it be corporate or government, whichever sector. My journey and experience with the Women in Power program is phenomenal. I learned self-mastery, learning a bit about yourself and how you show up with other
sector. My journey and experience with the women.
Good evening again. Mr. Nkosi, you were finally able to join us. I'm glad to see that we've resolved the issue that we had with connecting you. Welcome.
Thank you. Thank you.
I already sort of gave a short introduction to our attendees as to the kind of conversation that we're going to have tonight, and that we're really looking forward to hear from you and some of the ideas that you have been sharing with us. I think the first interaction with your ideas that I have had was the paper of September 2019, which was quite an eye-opener. and I'm hoping that we can expand on some of those ideas here this evening and find a pathway towards a transformed economy. So thank you for making the time to chat with us. And I think without further ado, I should perhaps hand over to you to give your opening remarks and then go straight into the presentation, if that's okay with you.
Thanks very much, Puma. Good evening, ladies and gentlemen. My name is Reg Nkosi. I am the Executive Director of First Source Money. First Source Money is a research outfit specializing in money, banking, and macroeconomics. This is a rather unusual combination. We are the only institution in the continent that specializes in this type of combination. One of the reasons why we chose this was because in the area of macroeconomics, the study of banking and money is almost non-existent. So we thought perhaps it is one that we can focus on from our side here. We have, in association with us, research institutions in the US and Europe as well. Before First Source Money, I was a government worker, but also a banker, and also in the process I did a bit of hedge as a hedge fund manager. Right. I've been requested by BMF to talk about post-COVID-19, the policy options there. What can we expect of the country given this coronavirus? But before I do that, I thought perhaps the appropriate starting point would be somewhere before we deal with issues of coronavirus and the economy that's going to come thereafter. What the title says, post-COVID, a transformed post-COVID economy, policy options, what that title suggests is that the current framework which we operate in is fine, and therefore all we have to do is to look around for policy options that we have to fit in and then move forward. But unfortunately, I disagree that that is the way forward. It is for this reason that not only for Corona, but for other, like the 2007-2008 crisis, I sat down to think through as to what could be the best way forward for the economy, given where we are as a country. So the real starting point for me, before we go to the policy options, if you want, is to look and ask ourselves as a country, where exactly are we? All right. Now, the question, where are we and why do we find ourselves here, is pretty important. Because first and foremost, for the past 12 years, the country has been unable to move forward at all. We have been growing almost at about 1%. In certain instances, I think it has been well below 1%. And the question is, why is it the case? Why do we find ourselves here? But what is here exactly? For me, I'm trying to get this slide up. Okay. Yeah, for me, where we find ourselves is very, very important. If we have not been able to grow for the past 12 years, frankly, coronavirus is a mere incident that's just going to add on to our previous challenges. And the question is, why have we been having all these challenges? So I'm trying to move the slide forward. Having a problem here. All right. Okay, it's great. So if we find ourselves here, where exactly is here and what is it? Why is it that we find ourselves here? For me, here represents two fundamental areas that are very much related. The one here is, why do we find ourselves with such high unemployment? Why is there so much inequality in the economy? And of course, poverty. What we're also noticing is the high cost of doing business and indeed the high cost of living. That's the first here. Why does South Africa find itself in this particular challenge or these particular challenges? Why are they so, why are so intractable? And the second here is the here number 2 on your right, is we find ourselves with an economy that is not growing at all. Something ought to be amiss somewhere. And perhaps in much of Africa, we've been one of the slowest economies in terms of growth. And of course, right now, as we speak, we find ourselves in a recession. But also one fundamental here for me is the economic ownership of South Africa. It's not in the hands of the majority. 26 years since President Mandela walked into Pretoria. Could that be a problem? Indeed, if you were to ask economists, there will have lots and lots of answers to these questions. But frankly, there ought to be 1 or 2 or 3 concrete reasons why we find ourselves in this situation. In my own understanding, having had an opportunity to analyze the economy, I realized that there can never be any way forward until we look at fundamentally the model of our economic development. But if we were to sit down and ask economists to say, but exactly what is the model for South Africa? What's the economic development model for South Africa? You'll find that some may not even give you an appropriate answer because it is not stated anywhere, right? But if you dig through, you realize, look, this seems to be the way. So I've been able to establish myself what I think is our economic model. And this particular economic model is the primary source of all the challenges that confront this economy. And before we go and begin to put in place measures or economic policies, we shall have addressed this particular model. So to me, there are 2 issues, the economic development model, as well as the economic framework, which I find it as very defunct. But how defunct is what we're going to check right now. We should remember that the macroeconomic framework for South Africa is not a South African product at all, was never developed by any South African. It is a framework that was given to us by the IMF and the World Bank. And we accepted it, and we've been using it, and we continue to use it. It is also for this reason that there hasn't been any economist who has come up to say, well, look, we don't agree with IMF, we don't agree with World Bank, and therefore here is an alternative approach. What I'm going to give you is an alternative approach to what I call a defunct IMF, World Bank, and OECD macroeconomic framework. Right, let's get back to the development model. I'm sure you might have heard quite a number of people, including President, the Finance Minister, people in the Reserve Bank saying, well, the country does not have savings. Because if we do not have savings, then frankly, we can't invest. And if there is no investment at all, then growth and development won't occur. And frankly, prosperity in the economy will be zero. And that's quite true. I think it's very difficult for one to disagree with that. But savings, we have to define what savings are. It means me as a person, you as a person do not have money in your pocket which you can invest. But also you don't have money that you can place with bank or a bank or banks, because banks are supposed to be institutions or firms that pick up those deposits and lend them out to those who want to go about investing. So therefore, our banks need savings, which savings are not there in the country. And therefore, the banks cannot lend. That is the assumption. But I argue, as I'm doing now and I've done before, that this is not correct. And if you were to go to, to a document, a recent document by the Treasury, they call an economic strategy for South Africa, the starting point is that a country has no savings, therefore it has to go out and borrow money. And part of that process is we have to make the economy very competitive. So Africa as a whole, South Africa indeed, and the entire developing world must therefore have savings. And if they do not have savings, what that means is that we have to ask for foreign assistance in terms of foreign aid. Or if not, then we have to ask people who have these savings. So if the entire continent has no savings, so we have to go outside the continent for those savings. And that, in some instances, is called foreign capital. So that is actually the model. Our growth, therefore, us to grow, we have to have money in the pocket, we have to have money in the bank, and the banks have to lend. And if we don't have money, and the banks do not have money, then we have to accept money from foreigners. That sounds interesting, doesn't it? And what happens then? You have created institutions like Eskom, Transnet, and many other state-owned institutions. Because government doesn't have money, these institutions, therefore, must also go into the market and borrow money from there. So SOEs, in a way, must behave like any profit-seeking institution, like Nando's, Chicken Licken, Anglo-American, and so on. They must go onto the market and go and get money from the market. I reject this notion that we don't have money, and therefore propose another dimension. Now, if you look at this slide, you find that the arrow points rightwards. So since we do not have savings, we have therefore to have a framework, a macroeconomic framework, which says, right, where do we have to get money to invest? We have to tax people and the firms because we don't have savings. And then that tax becomes revenue for government, and the government has to spend. And because usually revenue is lower than the total spend of a country, in most instances, the deficit must be financed from, borrowings. Now, these borrowings, as we said earlier, could be borrowings from the US, borrowings from the EU, and borrowings from elsewhere. But the point, however, is that we have to finance our deficit from advanced nations. Or if we do not, when we have to create local capital markets from where the government must borrow. So that's how the framework is put together, all right? The macroeconomic framework. And hence, you might have heard a number of times the president talking, saying, well, look, we have a deep and liquid capital markets in South Africa from where we can borrow money. All right? And therefore, if we do borrow, then at least we can invest and develop ourselves. But once again, this framework, I say, is defunct because I don't agree with it. I don't agree that we can just as a country or as a continent depend on these so-called liquid markets. The question I pose is, who owns these liquid markets? The answer will come apparent shortly, but I reject the notion that we should solely depend on foreigners as much as also depending on our local liquid markets. But now, if the framework is like that, so if you look at the first line and second line, that effectively is the fiscal policy. All right? Your tax and your deficit must be financed by loans from outside. All right? Which could be the liquid markets, could be foreign loans from IMF. And you have heard this many, many times where they say, well, because then we don't have savings, we have to attract foreign investment. But in order to attract foreign investment, we have to keep our interests very, very high so that it's attractive. So what happens then? The economy hangs on to very, very high interest rates. Me, you, and many other people are very, very uncomfortable with such high interest rates, but it is the norm. Now, for us to attract these people, we not only have to have these high interest rates, we have to ensure that our inflation is attractive enough. Attractive meaning quite low. That's the reason why we have the inflation targeting regime in this country. It's because we don't have money. We have attract foreigners, and foreigners do not want to lose a bit. If they bring in 20 rand here, they should be able to remit 20 rand, which is more variable, or it's the same as they brought in. So inflation targeting is a consequence of this notion of us not having savings and borrowing money from someone. Now, if you look at the type of investment that South Africa has been attracting, 3/4 of it is hot money. So hot money is this money that comes in today, goes into our markets. From there, it can go out tomorrow. It's what we call footloose type of investment. So South Africa has even used, all of us, I think, use the phrase portfolio investment. FDI just accounts about 25%. Now, but FDI is the real investment that's necessary, like the Toyotas we have in this country, the BMWs and so on. That's real FDI. Hot money, however, is higher, but hot money itself has got lots of problems. But anyhow, this is how our macroeconomic framework is organized. All right? Now, we also have what we call the exchange rate regime. The exchange rate in this country, the regime must ensure that it is one that is able to bounce up and down. They call it floating, so that it makes it easy to balance ins and outs, and therefore buffer the volatility of the currency. So that is effectively the macroeconomic framework. So if you look, so from the fourth line there, attracting foreign investment, keep interest high, is the monetary policy. All right? Keeping inflation low is the monetary policy. And the exchange rate policy is, of course, the opening up of the capital account. What it means to open up a capital account, really, is that it's the same as opening our borders. So we open our borders and, no one should control them. Money should flow in and out as the police. It's the same as opening a border from here in Mozambique, between here and Mozambique, or here and Zimbabwe. You can imagine the flows of people. However, we don't do that for people, but we allow capital to come in that fashion. I find that extraordinarily dangerous. Now, if that is the case, it means, therefore, any form of development must be dependent on foreigners, or if not, local markets. But what we have come to see is all these local markets, the local capital markets, are actually flooded with foreigners. Of course, we've got some institutions in there like Old Mutual, all these insurance companies, and some banks, of course. So therefore, due to the absence of savings, South Africa must therefore mortgage its development agenda to foreign institutions. Hence, you've heard that Eskom had to go to the World Bank and pick up about $3.75 billion. Transnet is all over, has got money from China and so on. As a consequence of the scarcity of savings, South Africa must begin to sell its state-owned assets. Now, when just about to sell off SAA to foreigners, and after selling these institutions of ours, state assets, we begin to depend on those sold assets again. So Eskom, which is undergoing unbundling, is want to be sold off. They say it's want to be state-owned, but the same thing. If you have a state-owned that doesn't have its own money, but it gets money from a person like me, it means it's me who's owning Eskom, and I can't command Eskom to do anything because I have invested money in that. And indeed, that's the very reason why you find Minister Tito Mboweni in the recent past urging us that let's go and borrow money from the IMF for coronavirus budgetary purposes. This is the framework that has given rise, in my view, to the challenges that we have. But to produce an alternative and find that this framework, which is organized, which is given to us by IMF as defunct, is a tall order. But I find it very, very disturbing. And look, below there, I said this particular model and the framework as a whole is a key source of regulatory capture. Institutionalized corruption comes in as a consequence of us depending on foreigners, and then a few people who have money. And I think it's very easy to be subjected to subversion by some parties that have got interest in our economy. And therefore think that this type of development is what we call dependent or dependency development. And history tells us that it has never worked anywhere. Now, if this is the case, what then are the consequences of this particular practice? If we're dependent on foreigners, I'm trying to get this slide on. Okay. What are some of the consequences that lie ahead as a result of us being dependent so much on foreigners? There are lots of consequences which I think are unnecessary. But before we get there, I find that the institutional design of the macroeconomic institutions like Treasury and the Reserve Bank are very problematic. And because we depend on foreigners, we depend on the IMF, the World Bank, and other institutions, they basically dictate as to what sort of institutions we should have here and how these institutions should relate to each other. To them, what they want our institutions to be is to be highly compartmentalized so that you have a Reserve Bank here which doesn't talk as it should talk to the Treasury. And in fact, if some of you had a chance to attend some of their meetings, you realize the tension between them. Unnecessary tension is caused lots of paralysis because each one is trying to defend their own turf. Yet, both of these institutions are manned by the cadres of the ANC who report to the president at the end of the day. They are deployees of the president, they are deployees of the ANC. But not just that. Macroeconomic itself as a subject requires that these institutions shouldn't be so separate. But they're being separated by the very persons from whom we get this money. So that become, therefore, in charge of these institutions in a very, very subtle way. These institutions themselves are highly inflexible, very unyielding. Even in the case where we expect them to work very coordinatively together, they don't. If they do, in a very grudging manner. So you would have recently the president announced about $500 billion relief package. It took a number of weeks for the president to come up with that number, because of the horse trading that's supposed to be there. If we were depending on our own, from our own savings, assuming savings, frankly, there shouldn't have been so much trouble at all. We could be dipping our hands in a pot and supporting the economy. But we are being directed by the institutions outside this country, or all these money lenders, to make sure that these institutions that serve us, while obviously accountable to us, we hope, cannot work together as required. Third problem is what we call market-based. These institutions, as I said earlier, can only go out and borrow money from the market. Now, these markets could be domestic as well as external. In so doing, these institutions, foreign institutions and capital markets, exert significant influence on the very institutions that go to them for funds. And they promote the financialization of the state by ensuring that our markets are so deep and liquid and open. And they suggest that we should use what they call securitized debt instruments. And what are these instruments, and how bad, how good are they? What they say is that when you go and borrow, issue bonds, okay, to the market. And when these bonds are issued, in terms of the IFRS, International Financial Accounting Financial Reporting Standards, the moment the instrument is marked to market, it attracts so many problems. All right. The moment it's marked to market, it means it's obviously a traded instrument. And if there's a problem in the country, there are lots of fluctuations around these instruments. And people pull in and out because they're traded freely. One can begin to sell as they wish, others buying, and so on and so forth. There's almost no stability when it comes to that. And they demote the otherwise other instruments which could perhaps be far much more better than the securitized debt instruments. So South Africa, as we speak now, the design of the institutions and the instruments at play are all market-based. Yet, it's possible for us to use what we call non-tradable debt instruments, which are usually very stable and cheaper. And such non-tradable instruments do not attract reviews from rating agencies. So I therefore think that and say that the manner in which we have designed our institutions, it promotes institutionalized corruption. There's a lot of capture. By them dictating to us, obviously it means what? We're not doing things we should be doing. Someone is actually forcing us to do what they think is best. A lot of policy capture in there. And many of these players, be it in local markets or abroad, they exert significant amount of pressure on the polity. And much of the, shall we call it the entire financing of our development, does not support what we call the capital development of the economy. there is little economic transformation that takes place as a consequence, and the economy is highly financialized as a result. So those three aspects, the monetary policy, the fiscal policy, the exchange rate policy, added onto that is the institutional design of these macroeconomic policy institutions. The way they're designed in such a manner that we cannot benefit as a country. So here we are, dependency development. What are the key consequences? Because we have to borrow, debt piles up, all right? And obviously, if there's a lot of debt, you have to up your taxes, all right? When people are being taxed heavily, they cannot save money, naturally. High taxes means obviously poverty. With that poverty, you have to go and borrow money again. So it's a never-ending cycle because of the very system that we think is intended to support us. Therefore, you cannot even save, you cannot invest. So it's a vicious cycle. So dependency development is exactly what we do not need as an economy. As a consequence, therefore, because of the lack of savings and because of these people wanting to direct their monies into the areas they choose, we end up having no industrialization. Today, South Africa is deindustrializing quite fast. And of course, unemployment comes in and many other developmental challenges grow. Now, foreign money lenders like the IMF, they demand a lot from the central bank. They demand the central bank in a way to financialize the economy. Instead of industrializing it, the economy becomes highly financialized as a consequence of them demanding from the central bank things like high interest rates. So our monetary policy regime, I normally call it interest rate policy regime, undermines the very ideals of developing this economy. And part of the story that comes with that is that when our interests are so high and these people bring in money, foreign money, they begin to play the interest differential. They do not come to invest, they simply come to play the game between the high interest rates that we have and their low interest rates. And of course, they pick money in and out, they push money in and out. And some of these banks that are allowed to come into the country, they also begin to set up local financial services that continue to act in a manner inconsistent with development. For example, I mean, most of us are aware of the fact that we had a Net1, yes, a company that was involved in the payment of SASSA grants. That company is partly owned by the World Bank. And we know the scandal around that. And even these markets where they ask us to go and borrow money, they're also linked to foreign banks who lend money to us or in a wholesale manner. And when the money comes, because obviously they're there just to come in and out, they externalize all the money through the open capital account. So South Africa ends up in this place as a consequence of the framework which we have put in place, but also coming from the fact that development model is very, very extractive. At the end, we don't have as a country economic control at all. Foreign money ends up controlling us. We as citizens cannot control our national resources at all. Our agenda in totality becomes one that is dictated. Not long ago, some people, may have well, I think all of us actually may have noticed that President Zuma had appointed Des Van Rooyen. We were told, some of us, that he had to reverse the idea because he was forced by the banks. But whether it's about Des Van Rooyen or any other person, the point here is, if an appointment is made by a country or by a president, it should be informed by the imperatives of that particular country, not by imperatives of non-players. So we have in the economy a range of actors who are basically not even citizens at all. So the entire political economy is not controlled democratically by South Africans, but controlled by foreign national interests. And therefore you see instability, economic fragility, and all manner of negative things in the economy. So South Africa finds itself in this low growth environment largely because of what I think is a very wrong framework. So then, how do we move from here? Right. If the question is, how should we have a post-COVID-19 economy? How should the post-COVID-19 economy look like? Then I think the question is, if the current economy suffers from these disadvantages, then there's no way in which we're going to create an economy that is consistent with our developmental ideals. And therefore, I had created a macroeconomic framework, rather a development model, which looks like this. Instead of savings, which we do not have because obviously we are poor and we are so many people unemployed, we need to rely on the banks. Now, the fact that banks are said to lend money that is collected is well known, is well established. There's what we call the financial intermediation theory, as well as the fractional reserve theory. These theories also tell us that indeed banks cannot lend what they do not have. But the truth of the matter is banks do not need any person's money for them to lend. Banks create money as they lend. That is well established that banks lend savings does not make it correct at all. So if we're going to begin from a process where we have our own banks, which are citizen banks, if you want, creating that money and lending that money over to the state, is far much better a starting point than a point where we say savings are the ones from where we should get our investment. In fact, savings do not lead to investment at all. This is a point well known time immemorial. However, the fact that schooling that all of us had gone through says that banks need savings, no matter that is the story, that story is not correct. So in us trying to put together a macroeconomic policy framework that is consistent with the developmental ideals, we have to start by ensuring that banks are the ones that must be the source of the money that we need for investment. Now, you may want to ask, but we do have banks here, even if they create only money, the lending practices are so bad and so on. Well, of course it is the case. But a new post-COVID economy must be one which says that banks as institutions. Now, I want us to be a bit careful here. The word institution in economics shall mean an organization that has a social purpose, a societal purpose. Now, if our banks do not have a societal purpose, then it's important that government has to create banks that should serve society, not banks that should serve themselves or the owners. It is also for this reason, therefore, that we as a people must be in charge of our own money. Starting point is democratic control of finance or money. Democratic control shall mean the citizens must be the persons who must control the finances, not individuals, not foreigners. And if that is the case, this key starting point as well is the reorganization of the Reserve Bank itself. While I support the independence of the Reserve Bank, it's very, very important. I think all institutions of state must be independent. But they cannot be independent, however, of the democracy under which they're supposed to sing. They must sing to the tune of democracy, not sing to the tune of externals. So the reorganization of the Reserve Bank is central to ensuring that a bank-based economy that is controlled by the citizens is in place. Therein lies an opportunity of beginning to structurally transform our economy. Now, structural transformation there, the word structural transformation is not the same as structural reforms. Structural transformations, I mean industrialization or the upward upgrading of an economy from, say, agriculture into manufacturing and so on. So based on democratic money, it's therefore very easy to begin to transform our economy because investment will be from within our money, created by state or state banks, the Reserve Bank in that instance, and given over to institutions like IDC, the Land Bank. As you know, the Land Bank is facing problems because it borrows money and then lends that money. So the manner in which it is designed is also incorrect. China has designed its development banks and land banks far differently from the way we have. So infrastructural development, investment can easily therefore be sourced from our banks, not foreign banks. Hence the need therefore for government to ensure that state banks are created. For example, in Germany, there are about 1,700 public banks, public meaning publicly controlled. There are now about 1,500. These banks, which are state, they're not allowed to be acquired by any profit-seeking bank. They can merge amongst themselves, that's fine. So that is the type of banking system that we need in this economy. A public banking system wherein we can easily go and source money for investment, infrastructure, and so on. There can therefore be no need for us to have to go to the World Bank, to the IMF, and so on. So that is the first part. Now, what happens therefore to the budget deficit? Instead of having to wait for foreign money to finance our deficit, deficit could be financed either by the Reserve Bank. People call it printing money. Actually, the phrase printing money is a gold standard phrase. It doesn't apply these days. After all, even commercial banks print money when they issue you a loan. So our budget deficit should necessarily be financed through the South African Reserve Bank. If not, then these state banks must be the institutions that must support us fiscally. Therefore, sub as well as public banks must be fiscal agents of government. If we're going to have a post-COVID economy that is resilient, governments must begin as a matter of urgency to avoid issuing bonds. Now, you may ask, but what sort of bonds are these? Actually, we're talking about bonds on the secondary market. Treasury can issue a bond and the Reserve Bank can buy. That obviously is allowed, but not on the secondary market. On the secondary market, when we go back to the market-based system, which encumbers us with all manner of problems, we think a post-COVID economy must have fiscal and monetary authorities coordinating very closely. And in the manner in which we've been managing debt management, again, we manage debt through going onto the open market. It's unnecessary for South Africa to do that. If we were to look at the South African market, market-based finance, it's as large as Germany, yet Germany is the third or fourth largest economy on earth. Germany doesn't rely fully on these so-called market-based finance. It's a bank-based finance. So is Japan. So is China. All right. So it is important that when we begin to manage our debt, there is no need for us to issue these securitized debt instruments. We should begin to issue the non-tradable debt instruments and ignore completely people like the IMF, the World Bank, because we don't need them. We cannot go borrow money when we have the capacity to create money ourselves. One way of making our economy resilient beyond the recession and the COVID is to abandon the interest rate policy that the Reserve Bank is busy with. The Reserve Bank calls it monetary policy. In essence, it is not monetary policy. It is the interest rate policy. Monetary policy is a lot more complex, a lot more wider. What we do here is simply move interest up and down and then control inflation. That is insufficient for any development. There is no country on earth that has ever developed as a consequence of that particular type of monetary policy. One other area that we must ensure happens if we're going to attain a positive post-COVID-19 economy is to ensure that instead of targeting inflation, inflation is going to be the last component to be targeted. We have to target unemployment and we have to target credit. Now, those people have come and said, well, look, I think the best way to target, the best way to go about these targets is to target GDP. But I do agree with that. The difficulty is that if you begin to target GDP, which has to grow in this way and that way, we run the risk of having a GDP or an economy growing like it did grow in 2006, 2005, but benefiting nobody. We're about 5.6% in 2006, 5.4 in 2007, and before that 5. And so. But while the economy was growing, the country was getting poorer and poorer. And we were actually using inflation targeting. Now, there is particular type of credit that we need to target as an economy, not the credit that's going to non-GDP transactions. We have to target credit that goes to only those areas that create growth in the economy, so the productive sectors of the economy. The one fundamental area is we are reliant as a country so much on private banks. I think in the manner this democracy is organized since 1994, it's very, very easy for a private bank to disrupt a system in this country, and especially these private banks that are owned by non-South Africans. So we are calling for a monetary policy transmission infrastructure to be owned by the citizens of South Africa. not controlled outside, to the extent that if we're going to use, if the Reserve Bank or if the Treasury so seeks to distribute money in a manner they want, it should be distributed freely, not begging people, but using the people's infrastructure. So we think one way, therefore, of us producing a better economy is to ensure that our monetary policy, our monetary transmission infrastructure is people-owned. And of course, I do agree that it's important to have a floating exchange regime, but there's no need for us to have a to have an open capital account. The reason why we're having an open account is because we're dependent on foreigners, and wrongly so. There's not a single country that developed in history that had opened its capital account. China's account up to date is closed because China understands that when you open your capital account, you mess your economy. And China's development is purely from its own people's own banks, state banks, or public banks, if you want. Now, the institutional design that's necessary for us is one where we say a treasury or a minister of finance and Reserve Bank must work coordinatively together to effect the necessary to effect the necessary goals that are required to be effected in the country. I mean, for example, if our goal is to assist a productive sector, the Reserve Bank must work hand in hand not only with the Treasury, but with an institution like the DTI to effect growth in an economy by transmitting money through either Treasury or straight to the DTI. So we're looking for an institutional design that says, well, Reserve Bank is independent. It cannot be independent of the goals of the state. So coordination is so vital, and these institutions must begin to work together, unlike what we have today. And indeed, without democratic control of our money, we can as well forget that the system that has brought us here will ever change. Ladies and gentlemen, thanks very much.
Thank you very much, Mr. Nkosi, for having presented here tonight what is a novel development economic model and framework as to how we can go about dealing with some of the economic challenges we find ourselves in, challenges that you kind of laid out quite expansively in your presentation here, and it raises a couple of very interesting questions for me as well. Before perhaps giving over to some of our attendees to also engage on some of the ideas that you've presented here. What I found quite interesting was the idea around the coordination between the institutions, the Reserve Bank and Treasury, coordination between fiscal and monetary policy. So under this new developmental model that you've presented here, and please pardon my dog barking in the background, is dying for some attention. It's been a long day for both of us. We'll try to speak above him. How does the independence, how do we operationalize that coordination, and how do we define independence of those institutions in that context? Do the lines get blurred somewhere? How do we operationalize checks and balances that we ensure the independence of these? Or does independence mean something different under this new model and new framework, and not the way in which we've been taught to believe in the past? The second, you spoke about the Reserve Bank transmitting money directly to the productive or to financing the deficit, so monetizing government debt. And usually when we talk about this, the inflation boogeyman is raised as to say that is inflationary. Is it not then what is inflationary, not necessarily the practice of monetizing government debt or purchasing bonds in the primary market, as it were, but that it incentivizes runaway spending because you have this policy as a crutch that then becomes in inflationary? What of the moral hazard attached to that, in the sense that we know that we've got a reserve bank that is going to quote unquote print money for us, therefore we can spend as we please? Is our democracy strong enough to keep that in check? And I think perhaps just the last point for me that maybe we can respond to while we wait for more questions to arise from our attendees is that this shift in developmental model and framework will of course have its consequences in the short term. The so-called short-term pain of any shift or any radical or drastic shift, either in policy stance or policy trajectory. How short-term is that short-term pain? Because and remember in your paper you mentioned the short-term pain of the current economic model and framework, and it has been short-term pain that we've experienced for 25 years. Is there any way to develop the consequences of this radical shift that you presented in a way that they can say we have the wherewithal to adopt this new policy stance or to adopt this new development model and framework and still be able to compete competitively or even effectively within global value chains? That also with the proviso that I recently read an article in The Economist that said that in fact COVID-19 has brought an end to globalization to a large degree. How does that all fit in together, Mr. Gos? And then let's have a look at what everybody else has asked.
Thanks. Can I respond to that?
Yes, please.
Thanks very much. I am one of those persons who like independence of institutions. That gives them room to work on their issues without any disturbances from anywhere. I'm thinking, for example, if there's a Department of Trade and Industry, all right, there's a Department of Health. These are independent institutions of government, all right? They are government. But we see that they work together, okay, in achieving a particular end. But there's no way where the Minister of Trade and Industry or the Minister of Finance goes and instructs the Minister of Health what to do. The Minister of Health raises an issue, just as the Minister of, say, TTI raises an issue, and they begin to discuss as persons who have an objective of raising the living standards of South Africans. So we must at all times promote independence. Just as so many other SOEs, including Chapter 9 institutions, are also independent. But they cannot be independent from democracy at all. Because all these are subject to democracy, they're subject to us as a people. So they cannot be independent from us. So in effect, what I'm trying to say here is, the Reserve Bank cannot be independent of the wishes of Soweto, but not be independent by on the wishes of Brussels and Washington. So it has to listen to what Soweto requires, or has to know what Soweto requires, and then assist Soweto accordingly. So what I'm looking for is what we call operational independence. So you operate independently given your expertise and so on. Whatever constraints that you have, you obviously can even go to the third party, to another ministry, and say, well, look, we're facing challenges here, but how can we help each other? But that doesn't necessarily mean that you're being led by the other party. No, you're operating independently, but you're seeking advice as you would normally seek. So I think, therefore, what we had come to know as independence by the Reserve Bank was a political independence. But how can a monetary policy, which is an instrument of government, be independent of government policy? I mean, be independent of the democracy, which nominates you and me to be the ministers? You can't. So we should all reject this notion because it was brought in by the lobby from the banking system. Because the lobby from the banking system wanted the reserve banks to be attending them instead of attending to the national issues. So I think, therefore, independence is very important, and I promote it, and I think it should be maintained. But you see, I mean, look at this. If you were to look at what they call independence in the league tables, South Africa doesn't rank any worse. I mean, it ranks worse than some of the countries that print money. So what sort of independence is that? So I think what we're looking for here is a question of normal independence, as you would actually be independent, but working collaboratively together with other parties within the economy. Now, yeah, printing money and moral hazard. I think institutions like Treasury and the Reserve Bank, they sit on a lot of data, right? To say, including the DTI and many other institutions, they sit on a lot of data. To saying that, look, we don't have roads, for example, in the Eastern Cape. We don't have roads in Johannesburg, and so on and so forth. And that's easily accessible. Parliament is aware of that, all right? So Parliament would therefore be saying, given the constituencies which they attend, to saying, look, we don't have roads between here and Musina, for example, we need a road. Money for that particular purpose has to be made available. So it can't be a case of saying, we're just printing money anyhow. That's senseless, isn't it? I mean, that wouldn't be what even citizens want. Citizens want their money to be used appropriately. Mind you, the Reserve Bank money is sovereign money. It's not a Reserve Bank money. It's South African people's money. And the very people would want the money used appropriately. So they would have to find out, the Parliament would be there to say, oh, indeed, our road was constructed out of the Reserve Bank money. So printing money has been the norm in many, many countries for 40 years, 40. The Canadian government has been printing a lot of money, giving it to municipalities, bailing out municipalities, building the ESCOMs of Canada, railways, and so on, from the Reserve Bank. This has been happening right across the world. No inflation ever arises because money is printed sensibly. Unless the suggestion is that, well, President Mandela as a civil servant is so sick, he doesn't understand, therefore we should trust maybe a business person than the president, because the president is going to misuse the money. But the president is also accountable to Parliament. So we need a strong Parliament that must hold the president accountable. But also we need civil society, citizens holding the persons who have been given the chance to print money to account. So I do not see moral hazard creeping in here. I think there is that possibility, but given our democracy, I doubt very much that could be possible. Now, a radical shift, and how can it work? I think the starting point is, for me, is a case of, firstly, the Reserve Bank, for example, is under the finance minister in reality, all right, who is a political head. I think for me, it would be a case of saying, all right, how can we begin to shift our relations in such a way that they're slow enough not to break the existing system, but they're good enough to move away from the destructive system that we currently have. So that could use as well the Parliament in terms of how this can be coordinated up. But I see a quick shift being very easy and possible. For example, if you want now to have the budget deficit with 70% of the GDP financed by the Reserve Bank or by a state bank. We don't have state banks right now, okay? These others, actually, they're state banks, but they're not really full state banks. Parliament will have to pass a law, which can pass anytime, all right, to create a bank. And that bank will quickly lend money to Treasury. Treasury is accountable to Parliament, is accountable to other ministries, and so on. So that shift is very easy and I think very possible without any disruption to be caused. That's my sense. So there can't be pain, but there's a lot of pain in us delaying this move. Thanks.
Thank you for that, Mr. Nkosi. I have a couple of questions here from some of our attendees, and I think this one that always creeps up when this conversation is had, and that is of the assertion by the governor that we need to be at 0% interest rate for us to embark on quantitative easing, as it were, or maybe purchasing bonds in the primary market. And then saying that we can't do this whilst we have high interest rates, as well as the inflation question that is addressed there. I think Utuma also responded to this in one of his pieces. Perhaps getting your perspective will also be helpful here in quantitative easing, which means buying in the prime bonds in the primary market. Do we need to be at zero interest rates in order to embark on a program like that? And also, Rod mentions something about we need to create a space for second-tier banks. I'm not too well versed on what is meant by second-tier banks. Perhaps you can touch on that as well. And creating a space for second-tier banks, and how does that help us moving forward?
Right. Thanks very much. Kuma, in one of my articles to the Business Day, well, in fact, in my article last year, when the governor was all over the news saying that, look, QE, or quantitative monetary easing, by the way, QE, the phrase quantitative easing is a short form for quantitative monetary easing. So the appropriate wording is, the phrasing is quantitative monetary easing. So I put in my article that the governor is certainly mistaken. All right. There's no theory that tells us that. Absolutely no theory. But even if there was some theory which I do not know, and I tell you, there isn't any such theory that I wouldn't know. But let's move away from theory into evidence. All right. The Reserve Bank of Bangladesh, all right, had inflation at about 15%. In 2009 or thereabout. Well, according to the governor, he tells me that the inflation was 12%. He embarked on printing money, what we call printing money. Let's call it quantitative monetary easing. Inflation came tumbling down from what I investigated as 15% to 7%, and later came down to 5%. That is evidence. Even if there was a theory that was saying that, then we have to question that theory. I'm afraid there's no such theory. So I tried to write that in my article so that people should see the governor for frankly, he is wrong. He cannot back it. And I think I've also continued to say that it was perhaps one of those stories that South Africans create so that they can run away from responsibilities of assisting the country. So zero interest rates is a myth. It doesn't exist. It has never existed. And by the way, I think what you should also know is that what the Reserve Bank is doing right now, the purchase of bonds on the secondary market, is not QE. All right? This process is what we have always known in economics as reserve expansion. All right, or monetary base expansion. It does almost nothing to the economy apart from reducing the long-term rates. Okay, and it can do anything. I mean, it can buy as many bonds as possible. It has nothing to do with inflation. But because economics was taught incorrectly, banking effectively, when monetary base expands in economics, we think that leads to the creation of money and therefore inflation. And that's wrong. So that aspect of economics is actually wrong. The Reserve Bank of England had said it's wrong. The Reserve Bank of Germany said it's wrong. All reserve banks in the major reserve banks have said it's wrong. So zero rate interest doesn't exist. It's a myth, and South Africans must reject it with contempt. Second tier banking system. Yeah, but we must be very careful. If the World Bank comes and tells us that we need a second tier banking system, we should say, well, thanks very much, but we will do our own, banking system. All right. Second tier banking system is a banking system that is slightly lower than the current banking system that we have. Okay, and they largely talk to institutions like what do we call these? Not what do we call these banks that the low level banks like credit unions and just forgotten. Yeah, these credit union type of banks. You see, those are not defined as deposit-taking institutions, all right? And they do not create money in the manner ABSA creates, Standard Bank creates, and so on. And therefore, when such a bank is said to be operational in an economy, it's the same system of saving and getting money from the bank that money has been saved and lending it. It just doesn't work. So if you are going to create what they call second-tier banks, these must, in my view, be banks that have their capital level dropped down, but operating universally like a Standard Bank and ABSA or Nedbank would operate. But what we saw in Namibia, all right, the World Bank went there and told them we should create second-tier banks. They're not talking about the normal banks, universal banks. They're talking about far much lower institutions like credit unions and so on. And we should, in fact, be very mindful about it.
Thank you, Mr. Ngozi, for responding to that. I guess then, if there are no other further questions here, maybe I can ask this, and then in responding to this, then you can also just segue into closing remarks that give us an indication as to what now. Right? More than just continue to educate ourselves on what it is, the economic situation that we're in, and what are its fundamental features of it, and what other economic situations can we get ourselves into, and the agency that we have at our disposal to reach those. Very few things, Mr. Ngozi, I have seen are either black or white, and very few situations exist where we can have either or take all situations. Is there an opportunity here for a technicolor solution, in the sense that there are features that can work for us in the existing system, or is that a function of us moving in the manner in which you've described, slowly towards this new model and framework? Or is it either we move to this, or we are doomed to be stuck in the economic situation that we're in? I ask this question in the sense that the type of coordination, both at a legislative and an executive level, that will require even the coordinated move towards this is one that I don't know. Maybe I'm a pessimist, that I do not see our legislators able to effectively manage, or even for us as South Africans to come to an agreement upon. So how do we find a technical solution to the economic malaise that we're in? How do we use this opportunity that we have now to pause for a moment and truly think about things, and truly try to find a way to create a more equitable and a more transformed economy post this? One that gives us a little bit more agency as well in the global economy, because what you have described here is one where we take instructions basically based on the whims of those that pull the levers behind the curtains, as it were. What can we do tomorrow? What is within our grasp tomorrow? What is in our grasp 6 months from now? What is within our grasp in terms of giving a mandate to those whom we will elect in the next cycle, for instance? How do we begin changing things rather than just speaking about them over and over again?
Thanks again. We're in a very tight corner, all right? This country has not grown for the past 12 years, really, to be honest. I think the average now is just below 1%. The population is growing at over 1.5, and the GDP per capita is sinking. And with COVID added on to the paralysis that we've had since the 2007 crisis, it will be almost magical for this economy to grow. The 500 billion rand fiscal, not fiscal, stimulus that we had is chicken feed. So I'm aware of discussions that are taking place about how to reorganize the economy. But there are institutions outside of government, outside of the democracy, if you want, that are pushing a great deal, pushing the democracy in a direction that it may end up collapsing. To the extent that our leaders continue to listen to such forces, the very forces I was alluding to, we can expect a revolution to happen very shortly. Therefore, there can never be any other way outside of us having to gradually, but in a very pointed manner, move out of this by instituting some of these measures that I've just said here. Urgent monetary financing of state is imperative. If we fail to do that, the levels of unemployment will be frightening. Already we're projecting some, a 50% unemployment rate. Can you imagine what that would mean? So I think the transition from a current failed system to a new system has to commence as a matter of great agency. And there are so many levers we can put in place that can ensure that transition is smooth and effective. To think that we have time is to delude ourselves. We don't have time. In fact, this is the very time that we should reorganize. You must remember what's happening in the international community. The IMF, the Bank of International Settlements, the World Bank, the OECD, and other institutions, they're very much hard at work, trying to ensure that the system which they know best, which enriches them, continues. And if we fail to organize ourselves against this particular system, I'm afraid there's no future for this country. That's why the first slide there, that this current system has no future. And therefore, 3 months, 6 months going forward, my sense is within the next month or so, the president must begin to accept the fact that the situation will never be the same again, and therefore ensure that the Reserve Bank attend as a matter of great agency to the resurrection, if you want, of this dead economy. I just hope the meeting that's coming up on Thursday, the Reserve Bank is going to announce that they're going to do a great deal than what they've done right now. So within the next 2 to 3 months, significant stimulus has to be put in place. As we do that, changes to the laws must be put in place by Parliament to ensure that these transitions are within an acceptable framework, legal framework, without which I'm afraid we will find ourselves in terrible space indeed. So I would suggest that, and I think quite a number of people are beginning to listen. When we started talking about monetary financing, we didn't expect that Investec, would in fact come forward and support this view. It was a fringe view from some of us, and now we see that Investec, through the professor there are quite a number of people that I see now coming up to saying, well, look, we're in trouble. All right, we cannot be scared of inflation as if inflation is going to kill us, assuming there's going to be inflation. When in fact, what we should be afraid of is the lives of people. And people are literally going to be dying as a consequence of this system which are in now. And the shift move is necessary as a matter of agency. But of course, in a gradual manner anyway.
Mr. Nkosi, thank you very much. And I too feel the tide of more and more people organizing under the banner of modern monetary theory, as it were, and then thoughts along those lines. Exciting times indeed. The conversations are more robust, less one-sided, and I think this is what I appreciate the most. Is that differing views are being allowed to enter the global public square, and so that we can have that contestation of ideas, and it's in that way that we can have the best ideas emerge and the best path forward. So thank you very much for the time that you have taken to come and have a conversation with us about this. I hope you will let us call upon you every now and again just to bounce some ideas off you as well, and just to see how, as an organization, particularly in the Eastern Cape, this tempers our engagement with the policy-making space as well, so that we get the best possible solution out of policy-making in our country. So thank you very much for taking the time. Thank you very much.
Thanks very much. Eastern Cape should, in fact, work a bit harder. And I'm sure when I was there a while back, I used to stay there because part of my family is there. We were devising ways in which we can actually begin to uplift ourselves. But again, when you come this side, then you have another story. But it is a province that must, in fact, ensure that it progresses in a very fast way to embracing these new ideas that are coming up. And I think that support will be necessary from the Eastern Cape. And I think thanks again for having me.
Absolute pleasure. Maybe we can benefit from that Reserve Bank money going straight to farms in the Eastern Cape.
Absolutely. Thank you.
Ladies and gentlemen, colleagues who have joined us, thank you for taking the time and for engaging with us this evening. Please do remember to subscribe to the YouTube channel of the PMF, where this video will be available. Should you want to have a look at the slides or have a conversation about what is in the slides with Mr. Nkosi, please contact him directly, and he'll be able to advise on that front. Thank you. Have a good evening. Continue to keep safe, and we look forward to seeing everybody at the next session that we'll be having. Thank you.